Today we're going to talk about performance, our growth of accounts that people have in what we call securities. Those would be stocks, ETFs, mutual funds. What I find is that most people don't have a balance. In other words, they're taking on too much risk or they're taking on very little risk. They don't have a very good balance. They have a number of accounts in different institutions and they're not working together. One of the jobs as a financial advisor is to put a portfolio together so that the performance or the growth of all these accounts are working together. Back in the 80s and 90s, it was pretty well known what the stock market was going to do when we look back. You know, that's when the mutual funds were really coming out, people's 401ks were starting to be developed, people were getting to know 401ks, and back in the 80s and 90s, it was kind of easy to take a look at markets because they were always doing this. In '87, we had a hiccup, but in the 80s and 90s, for people investing in 401ks, we had a nice steady uptrend for about 2 decades. If you recall, back in the late 90s, we had a very bullish stock market. That was called the tech bubble. Eventually, the tech bubble in the year 2000 finally blew up. But the last 12 years have been a very rocky road for investors when it comes to performance or growing portfolios. The last 12 years have seen its shares of ups and downs. I attribute these ups and downs to the amount of information people receive on a daily basis. Remember when we had this nice steady uptrend in the 80s and 90s, people traded the market they were in. The market they were in was a nice steady flow. The problem that we have today is we don't have that steady flow, once again, because of the information that we receive on a daily basis. Remember back in the 80s and 90s, during these nice steady trends, we didn't have the internet. We didn't have iPhones. We were unable to get daily quotes unless we called our broker or financial institution. Most people found out what their positions were in the paper the following weekend. So when it came to performance or growing accounts, people were very steady Eddie with their investment decisions. But because of today's technology, we're constantly getting updates on what our positions are doing in our growth or performance accounts. Again, people are taking in too much information. Because of that information, they are not well balanced. What I mean by well balanced is they are taking on too much risk, or they're taking on very little risk and getting very little return. Again, the job of the financial advisor is to have a nice portfolio that is what we call balance, not having all your money in one position, hoping it works out. Financial advising people or advising individuals or couples with finances and monies and portfolios is a team effort. I use a lot of sports analogies on occasion, and there is no I in team. Well, when it comes to people's portfolio, there's not one individual position that should be dominating your overall portfolio, because if that position goes the wrong way, so does the whole portfolio. Now, we like to talk about, hey, what if that position does do well, then my entire portfolio does well? Unfortunately, I find that people normally don't have their portfolios balanced in that manner. Again, they sometimes get involved in trading the market they want and not the one that they want to have. So again, let's refocus. In the 80s and 90s, we had this nice steady uptrend. You remember those times, dollar cost averaging, your 401k, your IRA did very well. Then we had the ups and downs of the 2000 till current. Folks, I really don't think this is going to change in my opinion. But what people have to understand and what they have to work with their advisor is to make sure, once again, that they are not taking on too much risk and that they have their balanced portfolio so that their portfolio is keeping up with what they have as far as growth expectations moving forward. One thing I want to take a look at though, is during these ups and downs, what people are trying to do at times is pick the tops and the bottoms of the markets. If you recall, in 2000, if you got somewhere near the top, you did okay. If you got out or back in the market in 2002, you did okay. If you got out sometime in late 2007, you did okay. I'm reminding people here, I'm not putting a month or day, I'm putting years. They got back in the market in 2009, they've done okay. So one of the responsibilities of the advisor over the last 12 years is to pinpoint and have an understanding of why we're having peaks and valleys. A lot of people are currently saying we're having a peak now, 2012, because of the government debt bubbles around the world. So this is the communications that we're having with clients right now, are these government debt bubbles going to be a problem for people that are trying to grow their money, performance accounts. These are much different, in my opinion, than what we call income accounts, where people need income from their portfolios. These are normally people, they have money in the sidelines. These are usually people under the age of 50. They're dollar cost averaging in their account, their money in their accounts, and growing those funds as time goes along. A lot of people forget about what we call performance fee when it comes to management fees in their portfolios. A performance fee is very simple. The advisor gets paid a stipulated rate every year based upon the assets under management. And on the back end, they get a percentage of what we call the performance of the account, how much the account grew during a particular time frame. Normally during the first year, it's over a year period, then it's quarterly thereafter. So if you have a certain amount of assets that an advisor can manage or a certain amount of net worth, a lot of people should check into what we call performance fees. In other words, if your account's growing, so does the amount of assets or the amount of revenue that the advisor is going to collect from you as the investor. And at that same time, maybe they charge a smaller fee no matter what the account is doing over the long haul. That's what we call a performance fee. And with what's going on in the markets in the last 12 years, instead of the old 80s and 90s, maybe that is something that people want to take a look at when it comes to their portfolios. Again, the performance fee usually is charged a certain percentage every year, every quarter. Then at the end of every year, every quarter, there's a performance fee taken out based upon some percentage of what the account grew at during that specific amount of time. And I think as we move along with these highlights of 2000, 2002, 2007, and 2009, you can see where it's very important, in my opinion, to have that advisor on your side when it comes to these performance accounts. You're not trying to get the exact day or month, but you're trying to get into that range to help make sure that you're not taking on too much risk and making sure that your money is really not doing anything or underperforming. And that's what's very important for people in their portfolio, is having that well-balanced portfolio, not trying to hit a home run every time you come up to the plate, but hitting singles, doubles, and triples, and every once in a while hitting that home run.